I did want to touch on something that I mentioned I will get back to, which is that intentionally defective part saying that the grantor pays taxes. Here's the great thing about it.
And you have to explain what that means, because very few people, including myself, could articulate what you just said.
So we set up a trust. I'm the grantor.
Okay, meaning you're the one that's setting up the trust or funding it?
Setting up the trust, I'm funding it. Okay. I am gifting my full exemption to it of $15 million for myself, and it's going to be a slat, so my wife's going to have a separate one, right? This is all hypothetical. I love it. But this is realistically how it works. So I'm gifting my $15 million worth of assets, which ideally I used illiquid assets and got a discount. But anyways, I got that in there. But these are income-producing assets. Trusts do not get rid of income tax. But trusts are heavily taxed. They're taxed on income side on the highest rate. So I actually want to pay the income tax on that trust for two reasons. One, my tax rate might be a little less. I can do some good tax planning, and I've got my tax rate down. The other thing is, if I pay the income tax on those assets that are in the trust, what do those assets not have? Tax drag from income taxes. So they're now accrued with the income that was dispersed in that trust that's now getting reinvested. It continues to grow in that trust. And guess what? Because I paid the taxes on it, and the IRS does not recognize that as a gift. So it's one of the few areas where the IRS actually gives us a free gift. So
interesting.
I don't know if I like that term, but yes, there's sort of there's a version of that where it's I am benefiting the trust without having to recognize a gift.
Yeah, I'm going to use an analogy that might be bad, but I'm trying to like connect the dots here. So if you have a 401k that's a Roth versus a traditional 401k, and they both have the same limits, technically you funding a Roth, you're funding more money than a traditional, because the traditional, you're putting in the same money, but there's tax that still has to get paid from there, and who knows, let's just say the tax rate's the same. Still, like, you're paying with after-tax dollars, which means you get to fund more for your future, which will get amazing tax benefits and grow. Is that something similar to, like, the trust is you're able to actually fund more favorable, pay it outside the trust, versus if you had to pay it inside the trust, you might have to pay more taxes, number one, but that also results in having just less money in the trust in itself.
You would have tax drag on that asset. So let's say I live another 40 years, but I've been paying the income tax on here. The difference between me paying the income tax and the trust paying the income tax and what those assets grow to, identical assets, same growth, is going to be dramatically different because this one had to peel off some of that to pay taxes. The other thing it does, so if you think about who's doing this, they have an estate tax concern. We moved as much as we could into an irrevocable trust, but we still have a residual estate. So the grantor paying the income tax is also reducing their estate. So there's a little benefit there too. It's one of the few times where you might actually be happy that you're paying tax instead of the alternative, which is your trust.
So just to make this very simple, because I want people to be able to understand this. Let's say your trust has $1 million in it. You funded that, okay? So I'm assuming no taxes have to be paid on that initial funding the trust.
As long as you file a gift tax return that says I used my exemption.
Okay.
Correct.
If you didn't use your exemption, well,
then you have gift taxes on that, which is steep. So you would use your exemption.
Okay. And then let's say that million grew to 1.1 million the next year. Would you pay tax on that additional 100,000?
Only if there was a taxable event, just like any other part of our life. So if the asset grew to, what did we say, $1 million to $2 million, but there was no exit, there was no income tax recognized, then no.
Okay.
But as soon as you start to sell assets to reposition into something else, and now there's capital gains due, or that asset is kicking off rental income, or it's kicking off other income, there's some sort of tax due that's going to flow through to the grantor.
And then when a beneficiary takes money, they're also going to have to pay tax on the flow of that.
Yes. So if the beneficiary, ideally, they're not going to take straight distributions. We do loans, but you're going to look at the trustee is going to make sure that we're being as efficient as possible. But if taxes are paid on it, then yes, they can make distributions without additional tax. There's not a distribution tax, if you will.
Okay.
And so that's what you want to do during the grantor's lifetime. And then in the future, when the grantor passes, it's subject to trust tax rules, and there's nothing you can do about that.
That's fascinating. So there's trust fund kids could be getting access to capital through a loan, and it's totally possible that they have a death benefit that will pay into the trust when they pass away that could pay for all their outstanding loans that they took from the trust.